How did Donald Trump legally pay $750 in federal income tax the same year he lived in a gold tower? How does Warren Buffett pay a lower tax rate than his secretary? Stop calling it cheating. It isn't cheating. It is a blueprint. The 1% don't pay taxes because they don't earn income. At least, not the way you do. They earn depreciation. This is the single most misunderstood concept in finance. It is a phantom loss that the IRS begs you to take. It allows you to have a bank account full of cash, while your tax return says you are broke. If you are a high earner, a doctor, engineer, or business owner, paying 35%, 40%, or 50% in taxes, you are being robbed by your own lack of knowledge. Today, I am handing you the 0% tax blueprint. We are going to deconstruct the God mode, strategies, cost segregation, reps, and the short-term rental loophole that turn the tax code from a weapon into a shield. Let's get to work. Welcome back to Wealth Architect. I'm Ben. Let's talk about the employee glitch. We are trained from birth to believe that taxes are a mandatory penalty. You work, the government takes their cut, you keep the scraps. That is true. If you are an employee, the tax code is 70,000 pages long. 10 pages are about how much tax you have to pay. The other 69,990 pages are about how to reduce your taxes to zero. Why? Because the government is lazy. They can't build housing fast enough. They can't create energy fast enough. So they write the tax code as a blueprint of incentives. They are saying, if you build housing for us, we will let you keep your money tax-free. The architect does not hide income. The architect transforms income. Today, we are going to learn the alchemy of finance, transmuting taxable ordinary income into tax-free phantom loss. This is the blueprint your CPA is too scared to show you. First, we must understand the tool, depreciation. When you buy a rental property for $1 million, the IRS assumes that the building is slowly dying. It's rotting away. Because of this entropy, they let you deduct the building's cost over 5 years. This creates the two worlds paradox. The real world. Your property is appreciating, going up in value, and paying you rent, cash flow. You are getting richer. The paper world. The IRS sees the building decaying. You are getting poorer. This gap, getting rich in reality while looking poor on paper, is the shadow market where the 1% live. You don't pay tax on phantom losses. You only pay tax on profits. If you have enough phantom losses, you have no profits. Now, here is where most YouTube videos lie to you. They say, just buy a rental and write it off against your job income. Wrong. The IRS is smart. They created a firewall called the passive loss rules. They categorize income into two buckets. Bucket A, active, your route to job, your law practice, your business. Bucket B, passive, your rental properties. Here is the trap. You cannot use losses from Bucket B to wipe out taxes in Bucket A. If you are a doctor earning $500,000 and you buy a rental that loses $50,000 on paper, that loss is trapped in the passive bucket. You can't use it to lower your doctor taxes. It just sits there, waiting. So, how do the rich do it? How do they wipe out their active income? They use two specific keys to unlock the firewall. Key number 1, real estate professional status, reps. If you or your spouse spend 750 hours a year managing real estate and it's your primary job, the IRS unlocks the buckets. Suddenly, your rental losses become active. Now, that paper loss from your apartment complex can wipe out the tax bill from your $500,000 salary. This is the holy grail for married couples where one works and one manages the portfolio. Key number 2, the short-term rental loophole. Don't have reps? Can't quit your job? There is a backdoor. if the average stay of your tenant is 7 days or less. Think Airbnb VRBO, and you materially participate. Manage it yourself. The IRS does not consider it a rental activity. It considers it a business. This bypasses the passive loss rules entirely. A high-earning software engineer can buy a beach house, run it as an Airbnb, use depreciation to create a $100,000 loss, and use that to wipe out the taxes on their View 2 salary. That is God mode. Now, how do we make that loss massive enough to matter? Standard depreciation is slow, 27 years. We want it fast. We use cost segregation. We hire an engineer to walk the property. They say, this isn't just a building. It's $50,000 of carpet, $30,000 of fences, $80,000 of lighting. These things depreciate in 5 years, not 27. Using bonus depreciation rules, check your current year's percentage. We can accelerate huge chunks of that value into year 1. You buy a $1 million property. You do a cost seg study. Boom, you get a $250,000 tax deduction in the first year. If you are in the 40% tax bracket, that deduction just put $100,000 of cash back in your pocket. The IRS effectively paid your down payment. The final question. Ben, don't you have to pay the tax when you sell? Not if you are an architect. The 1031 exchange. When you sell, you roll the profits into a bigger building. Tax deferred. The refinance. If you need cash, you don't sell. You refinance. You take a loan against the property. Loans are tax-free debt, not income. You spend the bank's money tax-free while the tenant pays off the loan. The step up. When you pass away, your heirs receive the property at its current market value. All those deferred taxes wiped out instantly. This is called buy, borrow, die. It is the engine of dynastic wealth. The tax code is not a mystery. It is a map. The government is begging you to become a housing provider. If you accept that mission, they will give you the keys to the treasury. You can stay an employee and complain about fair share, or you can become an architect and play by the rules of the 1%. We are building a community of architects. If you want to see the specific legal structures we use to protect these assets, hit subscribe. Let's start designing your freedom.